Hey everybody, this is Jim at SB500chart.com coming to you on Saturday, May 19th, 2012. And we're going to use some time-honored techniques to understand modern markets. And this is one of our featured daily technical analysis videos of the S&P 500. It's also our weekly review where we take a look back and see kind of what worked and what didn't. I want to remind you that the website and the video are for educational purposes only. Nothing stated at the site or in this video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research. And you need to make investment decisions that make sense and are suitable for your personal financial situation. I am not a licensed financial professional. I'm just a guy who draws lines on charts. And by the way, if I were a licensed financial professional, should you trust me? Probably not. So anyway, let's take a look. Okay, we are going to do things a little bit differently today. You're going to get a little bit more value for this weekend, call it a weekend update, I guess, weekly review. We're going to take a look at a few other charts that I hope will give us an idea as to what to maybe expect for the broader markets. So it's really going to be interesting. But here we are looking at a fairly long-range chart. This is a 2-day chart that goes all the way back to the 3/9/2009 market bottom. It includes the two what I would call fairly major tops that we've had since then. You could see that that we are in something of a constricting pattern, but I really wouldn't call this a rising wedge. But the reason is because the psychology of why rising wedges create downward momentum is because there ceases to be an adequate profit motive within that little wedge. So as you get squeezed up into a very narrow wedge, you're thinking, gee, the best the market's going to give me now is going to be 1.5%. Where's the payoff? So at that point, longs start to get the idea that it just ain't worth it. And at that point, selling takes over. Well, even though these lines are intersecting somewhere off in space, off to the right of the page, there is currently a huge amount of distance between the bottom and the top line. So there is lots of wiggle room here, lots of room for longs to go into this market as if it stays between these two lines. This market could go up for a long time before we get the idea that there's nothing in it anymore. But that said, this line is still important if it were to break. Okay? If this line were to break, then I would expect the market would come down to this blue line right here, which served as the bottom of 2010 and the bottom of 2011. So if we were to really just keep plowing through support, then look for this line to put up a strong fight. And if this line were to give way, and this is way out into the future, guys, then we'd look back to this line. So for right now, isn't it funny how all of these lines that we're talking about have their nexus, if you will, right here at that October 3rd low? And I confess, I missed that low. That burns me up. I don't know why. I think I was looking for just a little bit lower or something, but I missed that low. Well, live and learn. I'll try to do better next time. Right now, we've got a couple of intermediate support levels that we are looking for, looking potentially at. And here's what I want to show you. Here's the neckline from our head and shoulders top. Here's our break. And you can see we had this little consolidation pattern that broke down, and then we had, this week was one of the worst weeks in the S&P for a while. We had nothing really but selling all week long. where we went from a high on Monday in the mid 1340s, closing 50 points lower at 1295. We also took out this blue line, which was the 711 tops line. Didn't have much trouble taking that line out. And, I guess we need, the moral of that story is, if you have a rather esoteric long-range trend line drawn across 2 points that are 4 years apart, and the last touch was 5 years ago, you probably ought to just stick with what the Head and Shoulders says. And the Head and Shoulders says we're going to 1308. Well, this week we made 2 targets. On Tuesday, we made the target that we had mentioned from the height of this consolidation pattern. And then on Thursday, near the end of the day, we made the minimum target from the Head and Shoulders top formation. And again, just to remind you, how do we get the minimum target? Now, I want to stress that. Minimum target. That doesn't mean that's where it goes. That means it's going to go at least that far. So you measure the top here, the height of the top from the neckline, left shoulder, head, right shoulder, and then you add that on to the spot where it broke down, and that's where we got our 1308. Now, as we sit today, we are all kind of left guessing, and by the way, now it looks like this line right here is serving as some resistance. As this just kind of gets out of shape, there's all kinds of interpretations that we can make. I am keeping this top line. This bottom line, I think I'm just going to scratch it for now, because when you're in a downward trend, the bottoms tend to run ragged. Not always. Sometimes it's fairly controlled like this was. But when you really start getting some emotional selling, typically in a downward trend, the tops tend to line up. When you are in an upward trend, the bottoms tend to line up, and the tops can run ragged. So I'm thinking maybe our bottoms are just going to, that sounds kind of bad, our bottoms are going to run ragged. But that is a possibility. It's also possible that we are dealing with something now like this. But, I just can't be too sure, because it puts on a different face every day. Let's go ahead and keep this for now as the latest incarnation. We'll make these kind of little brown lines. And guys, it really feels like the market is due for a bounce. And, if this flag right here is one of those flags that flies at half-mast, as they often do, then this is the height of the flag. You see that? I'm going to the top of the head here to where this bottom is. And then if we measure from where that broke that pattern, that means we could maybe expect some support around the low 1280s. Let's see if we get it. Again, that's not a solid prediction. That's just kind of an idea. Now, what I want to do now is take a look at a few other charts, though, because with the S&P having met its minimum downside target, I think it might be wise if we look at some other charts to try to get an idea about what might be going on in other indices and also in a major sector. So let's take a look. Okay, we're looking at the Dow Jones Transportation Average. This is a very, very simple chart because I do not chart this on a day-by-day basis. But I've got a line here drawn under the 2009 lows and then again the October lows. And one thing I want to show you with the Dow Jones Transportation Average is that it failed to make a new high back in the earlier part of this year. This did not have the corresponding shape as the S&P did. So in addition to this line, just by way of a warning line in case it were to get there. I think we can draw this line right here around 4,000, and I'm not saying that this line is going to break. This line should give some support, but if this were to break, then I don't see any reason to expect support until about 4,000. That does not mean that the market might just get hung up here at 4,200 and then go up. But there's no reason to really expect that to happen based upon the chart. And what I mean by that is this: as we look at the way this chart has traded, you can see that there are many places where it just came down to a level and then decided we're going back up. And you really couldn't predict where that level was going to happen when we were in this early part of this run up. So you hear what I'm saying. If we are now in an area of volatility, then almost for no good reason we could turn up at any point. However, if we look at a 10-minute chart, not a 10-minute, an hourly chart, you'll see that, boy, that looked kind of like an inverted head and shoulders right there, but it wasn't. And if we back out on a 2-hour chart, what I want to show you is it looks like the industrials made a flat top triangle that instead of breaking up, broke down. Typically these break up, but this one didn't. And if we look at the first reactive move right here, use that as a measuring stick, then we see that the Dow Jones transportation average indicates that it still has a little ways to go before it will have met any minimum target based upon this pattern that was really kind of where it topped out here. Okay, let's look at another chart. Looking at the NASDAQ composite, another head and shoulders top. Again, we didn't get that extension over here to the right side like I was hoping we would, but you can see that this top, we measured the height of the head, the point of the breakdown, and this has almost made its minimum target. If we move out to a daily chart, you can also see that that this high right here, you might expect, maybe a little support at that point where it was once resistance, but I don't know that you got a whole bunch going on in this chart to tell you anything that may pick this up. And one of the reasons is that if you take this line and snap it as a parallel, you can see that if this did define any kind of channel, we are now under that. So I think the real operative thing here is probably this neckline. That should provide some pretty strong support, or this could be one of those cases, like I said, where the market just decides we've sold off enough, it's time to go back up. And something like what it did back here, for example. So let's see what we get out of this. But this the NASDAQ composite has almost made its minimum target from that head and shoulders top. Dow Jones Industrials has not made its target, and it's a little bit different pattern. It's almost a little bit of a broadening top, but clearly you can see three peaks and the breakdown. Here's your height of the highest position on this chart, and there's the area of the breakdown. Dow Jones, if the chart can be trusted, and this is a typical top, the minimum target has not been met. And if we look at it, you can see that target is at about 1290 roughly. So that's got a little ways to go yet. But if we back out, then we take a look at these levels that served as resistance back with this inverted head and shoulders, essentially calling this basically a neckline, if you will, then you can see that that comes into play potentially before this. So let's see if maybe if the Dow Jones Industrials maybe gets a save from this line, or whether it's going to go through that all the way down to that 1290 level. This line right here could give it some support. Here's the Russell 2000 small caps. Has not made its target yet. Pretty clear head and shoulders top here, and there's our target. Has not been met. This target is at 725 and change. So the Russell looks like it's got another 3% to go before it reaches its minimum target. So, and boy, you can really see that rising wedge right here and how that broke, then formed the right shoulder, and now that's a broken pattern. So you can see what we're looking at here. This, I don't see any real reason for this to not make that target. It doesn't look like there's going to be that much to run interference. And now we're going to look at a sector that is, I think, very interesting, and that is the semiconductor sector, the SOX Semiconductor Index Fund. And it looks like this is a really big head and shoulders here, going all the way back to 2009. Okay, so we rallied off this bottom, left shoulder, head, right shoulder. Could it be? Got to watch this line like a hawk now, because after this stiff turn down, it's either going to bounce here and bounce nicely and save the day, or if this goes through, then look out, because the semiconductor index has a ways to go. So this, might be something that that we need to watch almost as a critical indicator or bellwether, if you will, because if we create that parallel line, and let's say it were to break down in the next few weeks and not bounce, then we're looking at a semiconductor index that will give up about 40% from where it currently sits today at about 50. We're looking at about 50 going down to about 30. So that would just, that would rock the markets. So we need to watch this as well. So as you can see, there's a lot going on. I really didn't get much into the weekly stuff that's going on with the S&P this week, but I thought it might be good to take a look at some of these other indexes and some of these other funds to see what's going on. We're going to look at one more. Okay, we're looking at the RIFIN, the Russell 1000 Financial Services Index. And to show you how charts sometimes can fail, it looked to me at one point like the RIFIN was a double top, and we should have gotten down much lower than we did. And something that I think when I mentioned earlier that there was that I failed to see that October 3rd low, I think the reason was I was looking at the RIFIN and I'm going, it's got further to go, and then it didn't. So I think the RIFIN kind of faked me out. But right now, again, there was something of a head and shoulders formation in this index. Not a perfectly formed pattern, but it pretty much correlates with what we've seen in some of the other indexes. Again, not a perfect specimen by any stretch, but I think this is about the way it lines up. And the RIFIN has satisfied its required downside. So probably the preponderance of banking and financial services in the S&P may be why the S&P has met its target, while we're still waiting for the Dow, and we're still waiting for a little bit in the Nasdaq. And so anyway, look, let's see, by the way, if we get a bounce on this line right here, because this line served as resistance for quite a while until it got up over that. So if the Riffin were to continue to fall, let's see if we get a bounce down in the 720s or so. So that is the weekend update, where instead of looking at detail in the S&P chart, which we did to some degree, I just wanted to take a little bit broader view of the overall markets. And I'll let you know where I am too. I actually was a buyer of a few things this week, and lived to regret it. Excuse me. Yeah, I was in two social networking stocks yesterday, and I should have known better. I'm going to hold them. I think they're going to work out fine. And believe it or not, I bought a small portion of Facebook just so I could say to my grandkids, I bought some Facebook on the day of its IPO, and I got it at 38.01. So I figured that when I heard that it was being propped up at 38, I figured, what the heck, I'll put in a stink bid at 38.01 and see if it gets hit. It sure enough did near the end of the day. And who knows, maybe we'll get a bounce this week and I'll make some profits in that. But look, I'm about 60, a little bit more than 60% cash with some select longs right now. And because most of my trading gets done in a retirement account, and I have no margin in both of those accounts, I'm not short anything. And my trading account, I'm not short anything right now either, because I'm a little freaky about shorting this market. It has really been putting a hurt on the shorts. I think if we get a major break of some of these support lines that I pointed out here, like that big head and shoulders in the semiconductor index, I think if that breaks, then we're looking at a major downturn. Or if we look at that chart of the S&P that has the line across the 2009 and the 2011 lows, if that line breaks, then I think that means we're in for a world of hurt. But look, guys, appreciate you taking time to watch this video. Thanks again. Take care.